Since Shopify went public in 2015, you can clearly see it's been one of the hottest growth stocks in all of the market. Over this period through the end of 2021, through November 2021, the company averaged an annualized rate of return of over 87% per year, turning $10,000 into $589,000. However, the theme of this video is that fundamentals matter, and they matter a lot. As you can clearly see, the price has been trading dramatically above what fundamentals would justify, as connotated by this orange line. As a result, the stock fell almost 80% from the period November 2021 to June 6, 2022. That's a staggering loss simply because investors were playing musical chairs with their money. Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. Proudly bringing you once again a subscriber request Tuesday. Now, I had almost 70 requests for this week, and it's getting to the point where I just really can't cover all that many stocks in one video. So what I've done is I've narrowed it down to 20 stocks that I believe have some important lessons or messages that I'd like to share with you that really help investors get a better overall handling of investing in general. So some of these stocks I like, some of these stocks I don't like. And I do want to make that clear. These are your requests, not my recommendations, as I always do. But the real theme of this video today is going to be fundamentals matter, and they matter a lot. Most investors take their lead from stock prices, and unfortunately, stock prices are pathological liars. They can lead you down the river. They can give you false signals and cause you to lose your hard-earned money because of, the emotional responses of fear and greed. And as Warren Buffett says, we need to be fearful when others are greedy and greedy when others are fearful. And so I'm going to take a look at these 20 companies here today, and I'm going to, clearly illustrate how these 20 companies are really driven by their fundamentals first and foremost and most importantly. Now, I am going to go through here and point out what you guys have been looking for. So I'm going to go to GIC sector here, the GIC sector tab. And, we've had two companies in the communication services, Interactive Media, which was Google, or Alphabet as it's now called, and then the alternative carriers, which was Lumen. And you'll see the importance of fundamentals here with these. Then we have some consumer discretionary companies, including some automobile manufacturers, which I've been on record as stating that I'm not really fond of. I think they're very difficult for the companies to make money, and as a result, I think it's difficult for investors to make money. And then we're going to look at a consumer staple, Tyson Foods, the packaged foods and meats, primarily known for their chicken, a couple of energy companies, a financial, two healthcares, an industrial, and then about a half a dozen or 4 or 5 information technology companies, and then finally 3 materials companies. So without further ado, if you will, let's go ahead and get into today's subscriber request. The first company I want to show you is First Majestic Silver Corp. Now, commodities like silver and gold, heavy metals, precious metals have been a fan favorite kind of for a long time. But as I've looked at these companies in my career over the time, I've never found them able to generate any real value. Now, it depends on what their operation is. This company, and again, using FastGraphs, I can go into the external links and go directly to what the company does. You can talk about, what they're doing. They're producing mines, their exploration and development, reserves and resources. So they're really in the commodity business. But one thing about commodities like gold and silver, they don't pay dividends typically. As we see here, we have a very minuscule dividend. The company can pay dividends, but the silver itself doesn't, nor does the gold. But what I really want you to notice here is the importance of fundamentals. Long term, this stock has basically gone sideways as the fundamentals have gone sideways to down. If you look at this from a performance standpoint, it's actually lost money over this period of time during a time when the average stock, as according to the SPY ETF, has averaged 12%. This company has actually lost 3.75%. So you can see it's mainly because the fundamentals never did anything. The next stock I want to look at, and I'm doing this in alphabetical order, is Brookfield Asset Management. This is a Canadian company. They call it an asset management company and bank. It has somewhat, I'll call it cyclical operating results, operating earnings. It does have a very nice dividend record, I want you to know. It's currently yielding 1.1%. You can buy it at a 14 PE. The company's been growing historically at around 21% a year. But again, you always want to run different time frames. More recently, the company's only been growing at about 6.5%. But even more to the point, the company is not expected to grow very fast. They expect to have a down year this year, followed by a couple of double-digit years, following that. The long-term growth rate for this company is not given by FactSet's analysts. So the point is, you can see that in the long run, the company's price has tracked its fundamentals. Its performance has been good. It's outperformed the SPY by a lot. It threw off way more dividend income and way more growth. But that was during the growth period. Remember, you can learn from the past, but you can only invest in the future. I think this company is basically still moderately overpriced relative to what the fundamentals ought to dictate. And this is assigning it an 11 PE. If you put a normal multiple, the normal multiple has been about a 17 PE, and that would give you a little bit of a margin of safety and even a rate of return here. But again, the cyclical nature of this company is what bothers me. What I do like is the dividend, which has clearly been increased every year, although the yield is not very high. Earnings yield is over 7%. So, based on how I like to look at stocks, that looks relatively attractive. The next one is Becton Dickinson, and here's a company that has historically traded at a premium valuation of about somewhere between, let's call it 19 and 20 times earnings. You can see that the blue line on this graph is a PE of 19.24. The orange line is a PE of 15 for a just under 10% grower. I would call that a fair value PE. And it did trade there for a couple of years coming out of the Great Recession, as I like to refer to it. But then it went back to its old ways, and then during this hot, exuberant market, we've had the stock very, very overpriced. Doesn't offer much yield. It has a relatively low earnings yield of 4.49%, as reflected by the multiple of 22.29. I like this company. I think it's a terrific company. I think it has a terrific dividend record. As you can see here, the white line is plotting the dividends. The payout ratio is relatively low. That's the area below the white line. You can see that they're paying out, something in the neighborhood of 30% of their earnings. So there's room for growth there. But I do think this one is a little bit pricey right now. And as much as I like the company, I would have been a willing buyer here when it was trading in 15 multiples and would have called that a bargain given its historical valuation. Big Five Sporting Goods is a classic example of what I refer to, fundamentals matter and matter a lot. You can see the earnings here during this period of time prior to what happened recently has had negative earnings growth, and you can see the stock price has tracked that. For this period of time, the company actually would have lost money, and that included the dividend. They'd have lost about 7.5% capital appreciation or depreciation each year, and that's strictly based on the fact that the fundamentals deteriorated. Now, they did get a little bit of a pop from COVID, and that, brought their stock price up. Now, it looks like it's disappearing. If I'm looking at the future, I think you're going to have a negative year so that, you could expect by looking at a graph like this, it tells me I would be expecting bad news to be coming out over the next quarter or two. And so it becomes relatively risky to own. However, the stock is trading at a ridiculously low PE and has an insanely high earnings yield of over 29.96%. But their analyst scorecard is suspect. So, these analysts are forecasting numbers here, but in the past, they've been wrong more than half of the time. So it's just clearly the type of company that's difficult to forecast, and I wouldn't put too much credence in what the analysts. But what I really wanted you to see looking at this was how the stock price, was driven by fundamentals over the long run. Devon Energy is another classic example where you have deteriorating fundamentals and deteriorating stock price over this time. We are getting a surge in earnings, and we're seeing the stock price, react to that. Looking at forecasting, the company is expected to have a real good year this year, a moderately flat year next year, and then a down year the following year. So the point is, there's a lot of cyclicality here and unpredictability. Once again, the analysts have been wrong more than half the time when forecasting this company. So I'm not sure how much you can trust these forecasts that we're seeing on this graph here. Personally, I wouldn't give this one much credence. It does trade at a low PE of 13.5, has a 7.37% earnings yield, and what looks like an attractive dividend yield. But the company has had a history of cutting their dividend in the past when the businesses turned sour. So I take that into consideration. The next one I'll look at is Eastman Chemical. Here's one I really like. It has a 2.72% yield. You can buy it at a 12 PE, a high earnings yield. I think we got a nice margin of safety in this company. I do believe the future looks real bright. If I look at the analyst scorecard, the analysts have been spot on except for COVID primarily. They did have a miss in 2016. But generally, this company, although it's moderately cyclical, has been a relatively credible forecasting company. The company, I think, offers good guidance to analysts, and they've been able to be pretty much spot on with their estimates. So I like this company. I like the current valuation. I think it's one that investors who are looking for moderate income, 2 3/4 almost, and some growth potential, some upside, might want to take a look at Eastman Chemical Company. Google. Now, this is one that you have to really use the chart. The long-term growth rate's been 38%. We know that. But as you shorten the time frame, you see that growth rate has slowed down dramatically and shortened the time frame even more. And we see it, spiking back up. This is a company that's expected to continue to grow at double-digit rates. But I do believe we're looking at a valuation that's still on the very high side. It's not that you would lose money investing in Google here, but I think if you're patient, you would get a better opportunity. This is purely growth stock, no dividend, as you can see. Has a very low earnings yield, but it does offer some pretty high growth. So here's one that if you're aggressive and looking for growth, you might want to take a look at. But again, I would be waiting for a better entry point on Google. Honda Motor Company is a classic automobile company. You can see, there can be long periods of time where the company actually makes no money. Very cyclical. They make money, they pay a dividend, but everything here is, pretty much unpredictable. The analyst scorecard is absolutely horrible. Automobile companies, very hard to make money and very unpredictable. So I'm not crazy about Honda Motor Company, although they make good automobiles and, they're a profitable company, but they aren't really giving me as an investor the options I want: growing income, growing capital appreciation, etc. Lumen Technologies, an alternative carrier. The very spotty dividend record. You can see how, the business has deteriorated over the last several years. And of course, that's led to a deterioration in the company's capital appreciation. They have paid a decent dividend, which allowed investors to squeak out about a 2.5% rate of return. But the dividend has also been shaky. So again, fundamentals matter, and they matter a lot. You can really see that when you look at Lumen Technologies. The numbers look great. High yield, low PE, very high earnings yield. But keep in mind, those numbers don't necessarily look so attractive if you're looking forward. Forward earnings yields and forward PE ratios and forward earnings can be suspect. The company has a pretty decent history of being predictable, but again, a lot of that predictability has been negative earnings growth, so keep that in mind if you're looking at Lumens. Magellan, Midstream, I like this company. When you're looking at these oil and gas storage and transportation companies, I think it's best to look at them at cash flow because these companies are all about the dividend. It's trading at less than 10 times operating cash flow. It historically trades at around 11.29 times cash flow. That's the blue line. So we even have a modest margin of safety, a cash flow yield of over 10%, and a dividend yield of 7.89, almost, approaching 8%. This would be one, if you're looking for income, now would be a good time to be entering this company. Forecasts are not for a whole lot of growth, but you've got a nice margin of safety and some capital appreciation as a result of PE ratio, potential expansion, and high dividend yield. You could make double-digit rates of return on this stock very easily over the next several years. So that's Magellan Midstream Partners. Shopify I covered in the preview. Again, you can see that, the stock was just ridiculously overpriced. If I take the normal PE off, it really becomes a lot clearer. And this is the danger of messing around with these high growth stocks. And when people get really enamored by them, and we've seen that over and over again, and we're starting to see it because we've had this hot market since coming out of the recession. Even COVID didn't hurt them a little bit, but then the company, went on to reach new highs, and now we're starting to hit, some weak economy, maybe even talking about a recession coming up, and the stock is very vulnerable. The valuations up here, where you had priced operating cash flow of 300 and 400 times cash flow, and the same with earnings. We had the same kind of multiples when you were looking at earnings, 255 times earnings. That's simply not a reasonable price to pay. The company would have to grow incredibly fast to do that. And again, the forecasts are for actually maybe 8 or 10% growth. but the stock price is still massively overvalued in my opinion. I think the risk here way outweighs the potential for return. Silgan Holdings is just a nice, steady metal and glass container company. It's been growing at double-digit rates. Stock price has tracked that. It now looks fairly valued based on, expected growth. It has about a 1.4% dividend yield, P of 12.5. This is what I would consider a good, solid company to invest in at a good, solid valuation. So you might want to do some more research on Silgan Holdings. Semler Scientific, it reminds me of Shopify. High flyer, vulnerable to bad news. We have a couple of flat years of earnings, even though the earnings growth has been pretty good for this company. If I shorten this time frame, it's averaged over 36%, but you can see that's comprised of 164% and 185% growth in 2018 and 19. Then we had negative 7% growth. You can see that affected the stock price. Then we had 22% growth, and that was, got everybody excited again. And then we hit negative growth of 33% expected for this year, and the stock price has collapsed. Fundamentals matter, and they matter a lot. It's just the underlying theme. Here's Samsung, which is a GDR, which is a global certificate, if you will, and, from the company. So we're looking at currency exchanges here and all kinds of other issues, but a very spotty record, very cyclical stock. Does have a decent track record historically. Based on current valuation, it does look inexpensive. No matter which metric you look at it with, it looks, very inexpensive right now. It does offer a 2% dividend yield. So, Samsung is, maybe an alternative to investing in Apple, as an example. Normally trades at 4 times operating cash flow. It's currently trading at 5 times operating cash flow. So that could arguably indicate a slight overvaluation, but I'll let you judge that for yourselves. Stanley Black & Decker, this is looking at it from a cash flow point of view. From looking at it from an operating earnings point of view, the stock price has clearly tracked earnings. There is some volatility when the stock price gets disconnected. It did drop very significantly during COVID, rallied. We're expecting a down year this year, and of course that had a major impact on the stock price, but it has a very good dividend record. And this is an A-rated company. It's extremely high quality, and I think this is a great time to be investing in it. Their analyst scorecard is actually quite attractive. They did have a couple of misses in 2012 and 13, but otherwise they've been spot on. The analysts are very comfortable. The stock was up strongly yesterday, up over 5%. I think it's actually down a little bit today. The last time I checked, it was down less than 1%. So that's normal, trading. But I like this stock here. I like the valuation. I like the dividend income and the consistency of the dividend income over time. So I would maybe take a hard look at Stanley if you're looking as a dividend growth investor. Toyota Motor is probably the best automobile manufacturer from an investor's point of view out there, but even it has had some really rough patches along the way. Very difficult to make money with these companies. Forecast to grow about 6.5%, but again, if these forecasts, have been reasonably accurate for given that it's an automobile company, but that's what Toyota looks like. The one thing I'll say about it, it's very inexpensive now, does offer a decent dividend yield. So if you were looking for something that was, a turnaround kind of inexpensive, then Toyota Motor might fit the bill for you. Tyson Foods is a basic food company. You can see that the price, has tracked earnings. It's looking like it's undervalued right now, although we are expecting a negative year next year. A lot of talk about food shortages and their, chicken plant that I think it was burnt down. There's some issues here. There's some risks here that you want to really carefully weigh before you invest, but they do have a good dividend record, a lot of dividend growth. The dividend growth rate has been over 14% historically. So you might want to take a good look at Tyson Foods if you're looking for another income dividend type investment. Moving on, you got Xerox Holdings. This was a classic growth stock for years. That's now just kind of morphed into a profitable company, but doesn't have any real growth. Very unpredictable, very cyclical. Analyst scorecard is absolutely abysmal. Very, very hard to forecast this company. Even though the fundamentals look good at a PE of under 14, earnings yield over 7%, and a dividend yield over 5%. I believe this is kind of a sketchy company, although it might be good for the next couple of years. If you were ever going to invest in it, maybe now would be the time. So you can take a closer look at Xerox. And then Yeti Holdings, this is they make the coolers and the insulated cups, as well as some outdoor furniture and things. very high quality products. The stock is a pure growth stock. It was another classic example, one that got overvalued. It might have gotten inexpensive today, but looking forward, I think it's just fairly valued with about a 15 to 20%, growth rate going forward. So I wouldn't get too excited about Yeti, but I think Yeti's investable if you're a growth stock investor. Zebra Technologies, another example, electronic equipment and instruments. If you're not familiar with this company, you can go into the website and you can look at the different products that they have, printing supplies and printers and, mobile computers and tablets, barcode scanners. It's pretty well diversified electronic equipment manufacturer. It's had a very consistent record of growth. The stock price has tracked that. It got significantly overvalued and now it's corrected. I don't think it's corrected enough yet, however. I would still wait for this one before I invest it. But anyway, there you have it. This is Chuck Carnevale saying thanks for watching. I'm going to start limiting these to about 15 to 20 stocks each week. There's a lot of stocks you guys asked me to look at. Some of them, I just had to pick the ones that I felt, would give you some information here. The theme this week was fundamentals matter, and I think you could see how important fundamentals were to each of these examples. Thanks for watching. If you liked the video, give me a like, subscribe to the channel. I'm looking for more videos like this. I am going to start doing some more comprehensive analysis of individual stocks coming up. We're working on a lot of things to change the channel. We're going to stick with the subscriber request, probably try to limit it to 15 or 20 stocks, as I said earlier, but we are going to try to give you some investment ideas going forward as well. And, if you haven't taken a look at fast graphs yet, if you own stocks, I can't imagine investing without the benefit of having the fast graph tool for perspective. Thanks for watching. I'll talk to you again soon.